Right now in Canada, the difference between fixed and variable mortgage rates is about 0.34%. Fixed coming in roughly at 3.99% and variables around 3.65%. Now, that sounds small, but on a $500,000 mortgage, choosing the wrong one in 2026 could quietly cost you thousands of dollars. And the problem isn't that Canadians don't care. It's that most people are making this decision based on headlines, fear, and what their bank rep prefers, not the math. And at the end of this video, I'm going to show you the strategy we use with clients who want flexibility without gambling. It's how you hedge your rate increases and quietly pay your mortgage off faster all at the same time. So stay tuned, and instead of guessing what the Bank of Canada might do, let's actually run some real numbers. We've all lived through mortgage whiplash. Variables were safe until they weren't. Fixed was too expensive until people wished they had it. And now heading into 2026, Canadians are stuck in the middle. Rates are lower, but they're not too low. Inflation has cooled, but it isn't gone and it's still sticky. And everyone keeps asking the same things. Should I lock in or take a gamble on a variable rate? And here's the frustrating part. Two people can make the opposite decisions today, both thinking they're making the right one, and quietly lose thousands of dollars and lose sleep at night, not even knowing they made the wrong decision. Now, I'm a Canadian mortgage broker. And I don't try to predict interest rates. I don't think that really helps people make better decisions. And to be honest with you, no one can be completely sure as to what's going to happen next. What I can do is run break-even math and stress test decisions, because math doesn't care about headlines. It doesn't care about emotions or what your cousin read on Twitter or TikTok. So here are the rules of the video. We're not doing rate predictions. We're not talking about hype. It's just math, cash flow, and stress tolerance. The three things that are truly important when trying to decide whether you should go fixed or variable. Let's start with today's reality. As of today, fixed rates on the low end are coming in around 3.99%, with variables coming in around 3.65%, giving you a spread of 0.34%. On paper, variable looks cheaper, and yes, today it is. But mortgages aren't decided by today. They're decided by what happens over the next 60 payments. Here's how this actually works. On a $500,000 mortgage at 25 years, at 3.99 on a fixed, your payment's roughly $2,630. At 3.65% on a variable, your payment's around $2,550. So variable saves you about $80 a month, right? But here's the catch. And this is where most people get messed up when they look at variables. For variable to beat fixed over 5 years, rates have to stay where they are or drop further and stay down long enough to make it count. If the variable goes up by 0.5% for a sustained period, it wipes out most of the savings. If it goes up by 1%, well, the fixed wins and the variable didn't even come close. I see this every week, and we saw a ton of this recently. Someone takes a variable because it's the cheapest option today. Then rates move, payments jump by $200 to $300, and suddenly the question isn't what's cheapest, it's why does this feel so stressful and uncomfortable, and why didn't I go fixed? The math didn't change. The tolerance for risk was never tested. Here's the honest takeaway for 2026. If payment stability matters more than optimization, or your budget is tight, or payment swings stress you out, a fixed at 3.99 is probably the right call, even if it's just that little bit higher today. If you have cash reserves, strong income, and understand the downside, a variable at 3.65 can make a lot of sense, but it's a strategic choice, not a default. This isn't about guessing where rates go, it's about choosing the option you can live with if things don't go as predicted. All right, this is where I'm going to give you something most people don't really see or talk about, and it's that bonus strategy I mentioned before. So far, we've treated fixed and variable like an either-or decision, but in real life, there's a third approach we use with a lot of different clients. It's a strategy designed for people who want variable without stress and for people who want to pay their mortgage down a little bit faster. But you do have to have that risk tolerance to be able to take the variable. How this works is instead of choosing between 3.99 or 3.65, you take a 5-year variable, but you opt to make the payments as if you took that 5-year fixed. So on an earlier example, the variable payment would be $2,550, but the fixed payment would be $2,630. You voluntarily make that higher payment on your mortgage every single month. Now, this is why it's so powerful. We're going to slow it down here a bit. The extra $80 a month doesn't disappear. It goes directly onto your principal, which means your balance at maturity is going to be lower, your remaining amortization shrinks down, and your total interest cost drops over the short and long term. You're quietly paying your mortgage down faster without changing your lifestyle. And this is the part that most people miss. If prime were to increase by 0.25%, your payment would naturally rise, but you're already making that payment. What changes isn't your cash flow, it's just where money goes. So instead of paying extra principal, it serves as a sort of rate increase and buffer. So you're effectively hedging both directions. If rates stay flat or drop, you win with faster paydown. If rates rise modestly, you're insulated, you're protected, and you're already making that higher payment. It just means you're not paying your mortgage down as fast. This is how me and my team think about mortgages long term. Not just what's cheapest today, but what keeps you flexible, calm, and in control for the next 5 years. And this is also where our team comes into play. We're not expecting you to watch the bond market every single day. Our team tracks this. We're going to track bond yields, prime rate expectations, bank price changes, and economic signals from lenders and economists. So if locking in makes sense, or if staying variable continues to be the better play, you're not making that call alone. That's the difference between choosing a rate and managing a strategy, and having someone help manage that strategy for you. So if you remember one thing from this video, let it be this. In 2026, the smartest mortgage choice isn't fixed or variable. It's the one that protects your cash flow, lowers your long-term interest, and lets you adapt when the market changes and shifts. And if you want help mapping that out for your specific mortgage, there's a link in the description below. You can click it, there's no pressure, it's just clarity, and we can sit down and explore your options and try and give you some personalized advice. My name is Myles Nowik, owner of the Nowik Mortgage Team, powered by Andy Mortgage. And remember, in 2026, the biggest mortgage mistake isn't picking the wrong rate, it's picking the right one for someone else.